All right. So I guess we will get this party started. So I want to wish you all good evening, and it's great to see everyone tonight. I'm happy that you took the time out of your schedule to join us for the economic and markets update. You all know me, Denise Snowstrom, the owner of Diversified Financial Solutions, but I do want to introduce my assistant, Mike. I know many of you, if you haven't met him, you've definitely talked to him on the phone. So Mike Scudero, just want to
Yeah, absolutely. Thank you for joining us, everyone, tonight. It's going to be we have a very insightful discussion ahead of us with Glenn and Dan, and it's going to be a good one tonight. Thanks for joining us.
Yeah. So I want to start. We hope that you all had a good holiday season with your family and friends, and that the new year is off to a good start. Our goal tonight is to make 2025 a great year for all of you. We look at the past 5 years, and all we can really say is, wow, what the hell happened? We have really experienced a lot of ups and downs, plus the constant news and opinions about what may or may not happen. It can all be really confusing and really quite maddening, to be honest. So tonight we're going to explore market conditions and share expert insights on the economic outlook for 2025. As your financial advisor, I'm blessed to have an amazing team that I work with to help me to help all of you. We all have 24 hours or 1,440 minutes in a day, and there are a lot of things that we need to get done. So having partners that I can depend on to assist me in bringing you the best products and services is priceless. So I want to first start off by introducing you to two of those partners tonight. For those of you that have attended the 20th anniversary party with the Village People about 9 years ago, or have been to any of these calls in the past, you might recognize these guys. I have known these gentlemen for over 15 years, so I'd like to introduce to you two of the executive committee members of Independent Solutions Wealth Management, Glenn Wiggle and Dan Naiman. So Dan and Glenn, I'd like you to introduce you. I guess we'll start with you, Glenn. Please introduce yourself to my clients for those that don't know you.
Hi, well, welcome everybody. Happy New Year. My name is Glenn Wiggle. I'm one of the founders of Independent Solutions, and I've been in the industry now for, it's tough to say, 30 years, which is crazy. Like you said, the last 5 was like a snap, and the last 10 seemed like it went in the blink of an eye. So, been around the industry for quite some time. One of the money managers for Independent Solutions. I manage the all cap portfolio along with Dave Mariacker, and I'm also the chief compliance officer. So. It's been a great bunch of years. We have over $1 billion under management, and we run a number of different portfolios that we'll talk a little bit about tonight, from asset allocation mutual funds to ETFs to tactical and stock portfolios. So thank you all for joining us, and thank you for the trust you placed in us to manage your assets. We appreciate it.
All right, thanks, Glenn. I'm Dan Neiman, partner in Independent Solutions for the last probably 15 years. Been in the business now 25 years, Glenn, which is also pretty long time. Known Denise for a long time, and like she said, we were all at Glenn and I were both at the Village People event, which we can't wait for the next one. I'm the chief investment officer and CFO of Independent Solutions, so I'm on top of sort of all the portfolios that we run. I run my own value stock portfolios and a growth stock portfolio as well. And some of you that are clients might be in some of those portfolios, or in Glenn's all cap growth model, or in some of our base allocation models as well. Like Glenn said, we're going to touch on all those portfolios. We're going to answer some questions about what the market's doing, what's happening in the economy, and sort of some curveball questions that Denise might have for us from clients. So I'm looking forward to it. I'm glad we could actually do this thing virtually and get in front of you without having to travel, thousands of miles. I'm in San Diego. Glenn's in Jupiter, Florida. So we're happy to be able to be a part of this event with Denise and be able to do more of these over the next few years for you guys. So with that, Denise, fire away.
Thank you. And it is great. I mean, that was one of the good things that came out of the pandemic, that we are really embrace these types of meetings virtually. And, it's brought the country together because we can all be here and be in different locations. So it is a wonderful thing. So, getting started, it has been an interesting, like I said, a couple of years, and 2024 was certainly quite the year. We've had a great year, and that's a wonderful thing. But at the same time, we have a lot of people that get a little bit concerned and say, "Well, gosh, can this continue?" So, Dan, let's take a look. Let's go back a little bit in 2024, and let's take a comprehensive review of some of the key developments that happened last year.
Sure. Well, 2024 was an election year, as we all know. So there was some bit of market volatility. We had a good year though, up 20% for the year, and the year before was up 20% as well. So 23 and 24 were solid years from a market standpoint. A lot of 23's performance was really focused on only a few names, whereas I think in 2024 we had a little bit more market breadth, right? We had a lot more quality stock go up with the market as opposed to just a few names. You know, the Magnificent Seven was a hot name, if you can recall 2023, when sort of the only stocks were going up were Nvidia and Facebook and a few other names. End of the year, though, we had some turbulence, you know, after the election, and we saw, I think, 9 straight days on the Dow go down in December, which was a record. And people were kind of panicking, I think, at the time. But what we realized as an investment committee, as we had our December call, was a lot of that was just profit taking, right? Eventually, portfolios, big institutional portfolios, have to rebalance, have to sell off some of their profits. And when people start selling off, computers these days start selling off a little bit more. But what we've seen since then is a little bit more stability over the first 2 weeks of the year. I wouldn't say a full rebound, but we've definitely seen, we've seen stabilization. And I think what we're going to see over the course of the next year would be maybe some of those same scenarios happening, a little bit of a downturn, then a stabilization, maybe a little bit of uptick like we saw today in the market. Inflation continues to run slightly above target. Employment growth was weakened slightly, but as an investment committee, as we have our calls, no one seems real concerned, as this really amounts to normal fluctuations in what is overall, we think, a strong economic environment. So I think we're poised to do well over the next 2 or 3 years. That said, we could have some downtime. I mean, there's no reason the market has to go up 20% every year. I mean, over time, we're talking about 7-8% on average of the S&P 500. Most of our clients in Independent Solutions are in some sort of asset allocation model or something that's more of a 65-35 equity to fixed income. So we're really only participating, 70-80% on the upside and trying to protect 20-30-40% on the downside. So most of our clients and most of our accounts were probably up 15% last year, not 20. So I think, building client expectations and understanding the environment we're in, where we've had a very strong economic environment, I think that will continue to, continue to push the markets, and hopefully with more breadth, like we had in 24 versus 23 with less breadth.
Well, Glenn, this one's actually for you. I'll throw this one your way. 2024, Dan had mentioned, was the big election year. Obviously, had a lot of attention around it, and it's pretty crazy to say the least. So how would you say, in your professional opinion, it had an influence on the economy and the markets at large?
Well, I mean, obviously, I'm happy with the result. I think it was a positive. Trump has a lot of pro-growth policies, whether you love him or hate him. When you look at the 4 years when he was in office, we were energy independent. We had a better border. He signed a new North American trade agreement. We had a peace accord in the Middle East. I mean, it seemed like things were more stable. We also had very low inflation. And so, during the last 4 years, we've had a lot of the opposite. We've had a lot of, honestly, just bad government policy. And that's one thing that we talk a lot about on our radio show I've done for 25 years, is how government policy affects the market and affects the stocks and the economy overall. And, we had a lot of, kind of headwinds, the last 4 years. Fortunately, the stock still did well, but from an economic standpoint, we had high inflation. Obviously, we shut our economy during COVID, which was a huge mistake. So I'm happy with the result. I'm happy we had a result. My biggest fear going into the election, as I told clients, was the hanging chad. Going through, everyone's old enough to remember, right, back in 2000 and the Florida debacle. Here we are with Pam Bondi again in the spotlight, interestingly enough. But that was a disaster. The markets were on turmoil for 6 weeks while they fought it out in court regarding who won Florida and who was going to be the next president. So I was just hopeful more that we'd have a solid decision one way or the other, but I'm obviously glad the way the decision went. I do think that, having a more efficient, smaller government is going to be very important. I will caution, however, that is one of my black swan kind of, keep an eye out, is if they cut too quickly, does that cause potentially a short-term recession? Although, having said that, I do think 1 step backwards is 10 steps forward, because as I've said in many other meetings, debt crowds out growth, whether it's your household, whether it's a business, or whether it's the government. And the more debt we have and the more we have to allocate resources to that debt service, the less money is in individuals' pockets or, in your household, if you think about it, or business, the less you have to allocate towards, growth initiatives or things like that. And so we've got to get that under control. And I'm hopeful that with the people that Trump is surrounding himself with, including Elon and Vivek, that they can take a strong look at it. But again, the word of caution is, they cut too fast. You have that potential for, that withdrawal of government spending in the marketplace having a negative, short-term effect. So just be cautious.
Yeah, so today was quite the day with the market went crazy. And just with the things that they might cut rates a little bit earlier than the fall, maybe over the summer. So the market liked that. So it's just, we'll see. We have inauguration on Monday, and we'll start seeing things go into play. I think I've been telling clients it's kind of like a holding period right now till we kind of see how things kind of fall into place, right? I mean, would you agree?
Yeah, absolutely. I mean, we've stayed the course pretty much. As Dan mentioned, the market's broadened out last year. So, we took that opportunity earlier in the year to move into other positions in our portfolio that were not necessarily tech related because, we're typically heavy tech and heavy growth. But, we moved into, Costco and companies like that were, a little bit, broader that because as Dan said, the market was participating on a broader basis and allowed us to lower the risk, but still, have the same type of returns. And we're still doing that. We just bought Casey General Store recently. So, it's kind of an off the beaten path, kind of outside of the NVIDIA, Palantir, Palo Alto, Broadcom, all those other, tech stocks in our portfolio. I will say, though, that despite the politics, and I've always been a how politics meets money kind of guy, I do believe that the AI and the technology is really going to be the driving factor. I do think it's as transformative or more so than the World Wide Web and the internet was in the 90s from a productivity standpoint and an efficiency standpoint. Of course, productivity drives earnings, earnings drive stock prices. And you're seeing that productivity and that AI be used industry across every industry, right? So clients ask all the time, where do we play it? What industry is going to benefit? All industries are benefiting right now, whether it's manufacturing right down to finance to medical to legal, every industry is benefiting from it. And I think that will continue to be the overriding theme.
Absolutely. Yeah. So, we talk about AI, but what other emerging technologies or industries do you think are going to be pretty transformative in the coming year or years? What are
Well,
some of the names that you think are good?
Yeah, so we own NVIDIA, we own Palantir, we own a lot of internet security companies like Palo Alto. So we're looking at that space. Robotics coupled with AI, they go together, right? So we've had both AI and robotics for a while, but it's not been consumer usable, right? Just like the internet. The internet was around in the 80s, being used by the government and the military, but it wasn't, for civilian use, we'll say, until the 90s. Once it got out to the general public, I mean, you saw industries and businesses just launch out of nowhere. Amazon is here today. Facebook. So the largest companies we have are here, that started, because of the internet. I can only, just imagine the new businesses and companies that will start. And you're seeing, obviously the big dominant players right now, Google, Apple, and others that kind of dominate the robotic space and the AI space, Elon Musk and as well. But again, I think you'll see more, emerging players and more new businesses that will form as a result of the new technologies. I just, I'm not that creative to think about what those will be. I don't know what the next Amazon's going to be, but I'm looking forward to seeing what it is. Maybe it's flying cars. I don't know. That's what Lomas wants. Mike's always talking about flying cars. My business partner's a car guy, so he's waiting on the flying cars.
You never know, right? I mean, anything is possible. It seems like they would say the Jetsons, right? They were kind of cutting edge where they had the TV, where they would, we'd order their food and it would come out, and they had flying cars. So, I mean, it's really the next step, right?
You can only imagine the technology, but I do know that, because of the internet and all the businesses and all the wealth that was created because of that technology and the businesses that were able to be created because of it, I'm super excited and optimistic about the next, bunch of years ahead. And I'm really looking forward to seeing what comes out of the AI and the robotics. It's gonna be exciting.
That's awesome. Yeah, it's good stuff. I'm excited too. So Dan, Now we're in 2025. What would you say are some projections and strategies for navigating the markets in 2025 and beyond? Like, what are you guys looking at, and what types of things should we be aware of, and what type of things are you employing in the portfolios to kind of help clients?
Sure. I'd say there's four main things or three things we're looking at, right? Is we're looking at buying opportunities. So if there's a pullback, what can we add to the portfolio? Like Glenn mentioned, adding a few non-tech names that might benefit from growth in areas that haven't seen growth recently. I run some value portfolios. You think of value, people think, oh, low stock price. Well, that's not always necessarily a value stock. A value stock is something that maybe just beat earnings or just increased their dividend or has been increasing their dividend over time and their stock price has kind of stayed the same. So their yield's gone up. So looking around the market for opportunities and utilizing cash that our clients have, whether that be from selling another stock, maybe that's underperforming, selling a stock that's gone up and we're trimming profits. There's lots of ways to create cash in client accounts. So buying opportunities is one. Portfolio rebalancing, something in independent solutions we pride ourselves on in our allocation models and even in some of our stock models, is continually rebalancing portfolios on a periodic basis, whether that be every 3 months, 6 months, or once a year, but making sure that when we rebalance, we're also potentially adjusting percentages in an allocation model. So if you have a large cap growth mutual fund, for example, and that's allocated 15% of the portfolio, but because of the growth environment we've been in, it's now 20% of the portfolio. If we rebalance that portfolio, we bring it back down to 15%, we've sold at the top, right? Buy low, sell high. So we've sold high and we're buying into something else that maybe that's underperforming, that if the market conditions change, there's a pullback, there's, a shift from growth to value, we can buy into the thing, into the holding that's underperformed or less percentage in the portfolio based on our allocation that we're trying to meet. The third thing is having a neutral allocation, having more of a balanced portfolio. I saw a question come through by one of your clients here. What do I do? I'll read the question out because it came through on the chat. I'm 74 and a half. I'm afraid I'm not going to be long enough to recoup if the market goes down. Well, should I get out of the market at my age? I'm scared to death about what's happening with Trump trying to buy Greenland or renaming the Gulf of Mexico, telling Canada they should be a part of the U.S. Okay, all three of those things are Trump things. They're not necessarily things that are going to happen. Sorry, Glenn. Fires in California, climate change. How is that all going to affect the stock market? Well, number three here is allocation, right? What is your allocation? Pulling everything out to cash is never going to make you any money. It's not going to help you live to 94. Okay, you need to be invested in the market, but the market isn't the S&P 500 for that client. The market is a conservative allocation of stocks to bonds, probably something in the 30-70 range or the 20-80 range stocks to bonds, which at Independent Solutions, we have models for everyone, right? So that client that's fearful shouldn't be pulling out. They should be reallocating, readjusting their risk tolerance if they're afraid, because you should still be invested in something. You should still be investing and making money on your money. And there's, especially in the interest rate environment we're in today, we can actually make money in fixed income versus maybe 5 years ago or 10 years ago, where the best way to make money in the stock market for income was dividend stocks. Now the best way to make money is fixed income. You can actually, get a relatively good bond price at a relatively good yield of, say, anywhere from 3.5% to 5%, depending on your risk and your time horizon. So really, allocation portfolios, that's what they do. And by us rebalancing those portfolios periodically, it helps us, again, buy low, sell high into different areas of the market. So I would say those three strategies, and those three strategies don't really change year after year, but those are the three strategies that we employ. And after 2 great years in the market, I would say we have to be really on top of those strategies going forward, especially like Glenn mentioned, if things happen too quickly and we see a downturn in the market, like your client asking the question, I'm afraid, right? We have to be quick to pull the trigger on a rebalance. We have to be quick to pull a trigger on selling a stock maybe that's underperforming and deploying that cash into something that's going to do better in a down market. Because just because we're in a down market doesn't mean stocks won't perform. There are some stocks that do better in a contraction. Consumer staples do better in a contraction. certain areas like energy stocks and utilities do better in a contracting environment. So we can shift some of our investments into those types of stocks. As far as an outlook for 2025, what are we looking at going forward? Our committee as a group, thinks that there'll still be growth. They think, we think as a group that the S&P 500 could hit 7,000 in 2025, and 10-year Treasury yields could hit 5%. And there's going to be fluctuations. There's going to be shifts in the market, and we need to be prepared for those unexpected shifts, as Glenn mentioned and I just mentioned about how we manage those shifts in the market.
Well, yeah, Dan, bouncing off that, I imagine it would help to combat against market volatility too, because we've seen some of that in the past few years. I mean, we saw it a bit in 24, as you mentioned a few minutes ago, with how so much of the year you saw 20-30% increases in people's portfolios was really good. You saw a bit of a downturn there at the end into the new year. What would you say to really help people more understand market volatility and its implications on its investors? I mean, some of those strategies that you talk about implementing, does that also help against market volatility to protect people with against loss?
Sure. Yeah. I mean, the whole idea behind everything we do at Independent Solutions is participate on the upside, protect on the downside. So again, back to client risk and client expectation, right? When a client is sitting and filling out their risk homework, and they might have a conversation at the country club or at the tennis court or with their buddy, and saying, "Oh, I beat," their friend says, "I beat the S&P 100 every year," and then they come and do our risk homework, right? And they start answering those questions as if they're their buddy, and all of a sudden their risk score is like a 90 or 100. Are they? Is that really their risk score? No, most people are somewhere between 40 and 70. I did a couple risk scores myself last night with some potential new clients, and I like, based on their answers, I actually guessed their score pretty close. I was within a couple points on one and almost identical on the other. That said, when the risk score, when a client has a risk of say 60, right, that means that they want to be 60% in to the upside of the market, but they also don't want to lose 40%, right? So we need to find portfolios that fit that. And that's what we do at Independent Solutions. We are not 100% growth with every single client, because that doesn't fit every client. That doesn't fit everyone's scenario. Some people want to be 100% growth with most of their assets, but even some of their assets, they want to be in something a little bit safer or something a little less risky. And so I think over time, when you do the things I mentioned, rebalancing, buying down stocks that have underperformed, or buying new stocks and selling out other stocks that are underperforming, you have the ability to manage a portfolio over a longer time horizon. And I think that our goal is really to put all that together for the client and for their investment advisor that they're working with, like Denise, and really give the expectation and the message that we're not trying to beat the market. We're trying to provide the right amount of expectation to you, the client, that you want, right? We're trying to match that expectation with the return so that we're all in line with what's going to happen in the future, if that makes sense.
Absolutely. Absolutely. So I guess we'll go to questions that we had received from some clients and see if we can answer some of these things. So one client said, I have a lot of money in cash, and it was great when I was getting around 5%. I'm afraid to go in the market, however. Should I keep my money in cash to be safe?
Sorry, was that to me, Denise? I had to.
Oh,
Go
good.
ahead. One more
I
time.
want to repeat. Okay, Dan. All right. So basically, a client has a lot of money in cash.
Yeah.
And said it was great when they were getting around 5%, but afraid to go in the market. However, should they keep their money in cash to be safe, or what alternatives should they do?
Well, I think there's some money market funds right now that are in the 4 to 4.5% range. I think over time, again, I don't know the client's time horizon. Is the client time horizon 6 months, or is it 10 years? Right? If it was 10 years, I would say you should probably have some sort of mix of value dividend paying stocks with fixed income. And the fixed income will help buoy you on those down days or those down years when the market's kind of going down. But the dividends from the value stocks will increase your yield on top of whatever fixed income can get you, and provide a little bit of growth to your principal, because over time, all stocks go up. We've seen that over the last 100 years. So while there will be downtime, I think over time, a good mix of dividend paying stocks will outperform cash, right? over a 10-year stretch. So,
Mm.
Glenn, do you have any input on that one?
Yeah, just depending on your time horizon, as you pointed out, Dan, I mean, I might look at this opportunity to lock in some longer term rates, right? I mean, you got, if you do want to stay safe and you do want to stay in fixed income and you do have a time horizon, let's say 5 to 10 years, interest rates are going to go down over the next couple of years. And so it would make sense to look at maybe, bonds in that 3 to 5 to 6 year range, depending on, again, your time horizon. So back to one of the things that Dan pointed out regarding the question that was in the chat box there, because we have asset allocation portfolios, we can take advantage of that volatility and we can rebalance. And to Dan's point, we've done a great job, I think, in some of the timing of the rebalances that we've had. And so because of that rebalancing, we've been able to recover from losses a lot quicker than, maybe somebody who just kind of stayed the course blindly. And what I do notice is, and obviously we've managed, over $1 billion and thousands of portfolios. There are clients that will time to time go to cash. And the problem is they never get back in before the markets are higher than when they went to cash to begin with. And so typically it becomes a nothing but a triggering of a tax situation with no really benefit. So I would just be cautious about, dipping in and out. Now we do have tactical portfolios that are meant to do that, that have a mechanism to get back in. So we're not, just guessing the market, or you're not guessing the market. So if that's something that concerns you, definitely let us know. And I will say one last thing. I do think that, we own Greenland by the end of Trump's first term, or last term here, no question. So over the next probably 24 months, I would say we own Greenland.
It's
Can I buy some shares of Greenland? How do we get that?
Well, they did a poll. I mean, actually, 2/3 of Greenland, 66% of the citizens want to leave, what is it, Denmark or whatever, and join the U.S. So they've got a lot of natural resources. I think that's a deal that Trump will actually put together. I know people think it's crazy, but some of the other stuff I know he's just trolling. I mean, obviously making Canada the 51st state. I mean, he is a master, troller. I mean, he's the guy who showed up in a garbage truck and he just knows how to get people going. So I think a lot.
He just wants to put a Trump. He just wants to put a Trump hotel up on Greenland.
Exactly. Make a Trump land or something.
So yeah, it'll be interesting, interesting couple of years for sure, but I think that we've just had quite an interesting couple of years, so I'm looking forward to it too, and we'll see what the next chapter brings. But I mean, as far as pro business, we need that. I mean, we're all business people, and that's the small business is the engine of the country. And if you get rid of some of the roadblocks of us doing what we need to do, it definitely helps out, and taxes. So I think we have a lot of good things ahead of us. And we've all been in this business for a long time. The market does work. We have goals that we want to aspire to. And even if it's, depending on your situation, some of us don't use all of our assets either. So it's going to the next generation. So that's something that we want to plan on as well. So maybe, you don't want to be too conservative, you want to be too aggressive either, but you want to look at your situation over the long term, and then, the market will do its job over that time as well. So, any last parting words, Glenn or Dan, before we wrap up? Because we're just about to the half-hour mark.
No, just Happy New Year, everybody. I hope to have a prosperous and everyone has a healthy year this year. I think it's going to be a decent year. I'm sure we'll have volatility as we'll get some profit taking and back and forth. But again, I do think that the transformative effect of the internet in the 90s is kind of where we're at with AI and technology today. And I think that it'll be interesting to watch over the next bunch of years. But you have a pro-growth president that is a pro-energy president, and I think that's super important. I mean, places in New York are literally running out of energy, and they can't bring the industry they want to bring in, and that can't happen. Our dependence on Middle East oil, that can't happen. And so I think when Trump was in office, we had $30 oil, and that helps a lot. Oil prices go to 90 like they have in the past. Now I think we're backed off of that, but that affects everything, transportation, and right on down the line. So having a strong energy policy is going to be a super important part, I think, of the next bunch of years. But again, I think technology is the AI is so powerful, and there are so many companies that are making these chips that are so amazing, like NVIDIA, that I think the future is extraordinarily bright. So I'm optimistic and looking forward to not only a good year this year, but a good couple years going forward.
Yeah, I'd just like to thank everyone for attending. I mean, I appreciate the faith you have in us managing your assets, and certainly we all love Denise. So glad you're her client, and anything we can do to help you guys in the future, don't hesitate to ask Denise to ask us.
Absolutely. And like I said, we're hoping to bring more of these programs to you throughout the year, just to keep you engaged and involved and see what's going on. I mean, you always hear from me, but sometimes it's good to hear right from the managers that are managing your money. And like I said, I'm so appreciative to them because I do so many other things for all of you, and they take at least part of that load off of me. But I'm always watching them too. No, you guys are amazing, and I appreciate everything that you do, and I appreciate all of you, and I thank you for taking the time out tonight because I know we all have busy schedules. But let's make it a great year, and I'm here if you have any questions from this evening, and if there's anything that you missed, we do have this recording. So if you want to watch it again, or if you have somebody that you want to share it with, by all means, please do. And don't forget, Glenn talked about his radio show, but he inspired me to do my radio show. So you can always listen to me every Friday, The Financial Chick at linewsradio.com. You can listen live. And or if you're in the area, you can listen to the radio at 103.9 WRCN LI News Radio. So I want to let you enjoy your evening. And again, thank you so much, and we'll hope to see you soon.
Thanks, everybody. We appreciate it. Thanks, Denise.
Thank you. Thank you all. All right. Have a good night.